The old saying goes, sell in May and buy back on St. Ledger's Day. Now, whilst this old saying harks back to a near bygone era when brokers would generally take the summer off, these days it's not quite so simple, as markets are a 24-hour and 12-month-a-year business. The UK markets are trading steady after last year's pandemic sell-off. However, there are still some share prices offering investors heavily discounted entries compared to pre-pandemic levels. So in this report, we highlight a group of stocks from varying sectors that we feel offer investors great entry levels after a despondent summer's trading. So stay tuned for our top 5 picks for this year's St. Ledger's lineup. But before we take a look at this year's suggested bargains, it's always useful exercise to hold ourselves up to the light and see how the 5 stocks that we suggested last year as our St. Ledger's bargains have performed over the year. So, how did we do? Well, Taylor Wimpey was our first, priced at 100 pence. Well, after reaching a high of 194, today they're sitting at 182. That's up 82%, so we'll notch that one up as a pretty healthy winner. Second up was the oil major BP, priced at the time at 238. After reaching a high of 336, today it's sitting at 298. That's a 25.2 increase. Not bad. TUI Travel was our third, 272 at the time, today 320 after reaching a very healthy high of 570, just over 17% growth over the year. So in our list was another blue chip, Lloyds at 25.8 pence at the time, today sitting comfortably at 44.3, having seen a high of 50.4. So if you bought Lloyds last St. Ledger's Day, you'd be sitting on a very healthy 71.7% return. And our final tip was Whitbread, 20.75 a year ago, today 31.87 after a high of £36, so another healthy return of 53%. So all in all, not a bad set of tips, even though we say so ourselves. But here at Atlantic Capital Markets, we never rest on our laurels. As another year is upon us, it's time to put ourselves on the line once again to let you know who we think are the current bargains out there and who you should be taking a close look at this St. Ledger's Day. So let's take a look at our picks for the coming year. Smith&Nephew plc is a British multinational medical equipment manufacturing company headquartered in Watford. It's an international producer of advanced wound management products, arthroscopy products, trauma and clinical therapy products, and orthopaedic reconstruction products. Products are sold in over 100 countries. Now, the business has suffered over the last 12 months due to drops in demand for their medical products, as hospitals across the globe have focused in on COVID care. Now, Smith&Nephew operates in 3 market segments through separate global business units under the Smith&Nephew brand name. Advanced wound management, that's looking at advanced treatments for difficult wounds. Endoscopy, products for minimally invasive surgery based in Andover in Massachusetts over in the USA. And orthopedics, that's hip and knee implants and trauma products based in Memphis, Tennessee, again in the United States. So the business has had a tough year as COVID-19 took hold last year. And this translated to hospitals around the world redirecting resources to the front line of the pandemic and postponing non-essential procedures. With the easing of virus restrictions, this has enabled certain elective surgeries to begin to return, and this was reflected in second quarter figures recently reported showing revenues jumping to £1.3 billion. The firm also noted that a strong performance in orthopaedics, that's up 43.3% underlying, and its other 2 franchises reflected not only the softening of COVID rules, but also, quote, decisions to maintain investment in our sales force, new product development and launches. John Wood Group plc, commonly known as Wood, is a British multinational engineering and consulting business with headquarters in Aberdeen in Scotland. Now, the business was founded by Sir Ian Wood in 1982 when it split away from JW Holdings, the largest fishing company in Scotland. Now, JW Holdings had diversified into the energy services business at the outset of the North Sea oil industry in the early 70s. The company acquired Mustang Engineering, Inc., an engineering business based in Houston, Texas, in September 2000. In 2002, the company was listed on the London Stock Exchange. In March 2017, the company announced it would acquire its rival, Amec Foster Wheeler, in an all-stock deal, valued at approximately $2.2 billion. Now, in 2020, the nuclear business, mostly involved in the decommissioning work at Sellafield, was sold for £250 million to the US Jacobs Engineering Group, which has a global nuclear business. Now, Wood Group cover various sectors including maintenance, modification, brownfield engineering and asset operations. They also work on optimization and management across several sectors such as conventional energy, process and chemicals, and renewable energy and power. Not only do they work in these areas, but also deliver a wide range of services such as project management, engineering, construction and project delivery, engineering procurement and construction management. And the firm also has a consultancy side, which is a global multi-sector specialist consultancy. A trusted partner to a wide range of clients across all of energy and the built environment. Now, the consultancy side also covers a wide range of sectors including renewable energy, upstream oil and gas, midstream oil and gas, downstream oil and gas, chemicals, power, mining, industrials and manufacturing, life science, transportation, water and government services. Now, the shares have been under fire considerably over the last year, especially as the pandemic hit the oil price and sector hard. That all being said, the oil majors are now recovering, yet the oil servicing stocks are still lagging. We've already seen the likes of Royal Dutch Shell and BP increasing dividends and starting to fight back. Whilst this recovery hasn't translated for Wood Group just yet, and recent figures highlighted that revenue fell almost a quarter in the first half of 2021, the outlook from here does look better. The fall in turnover did detract from the fact that the firm saw an upturn in activity in the second quarter, thanks to growth in consulting and operations, along with an improvement in operating margins. Also, the firm took in $3.2 billion of new orders during the first half, taking its total order book to $7.7 billion, up 18% from the start of the year. There's also expectation in the market that Wood Group could be a major beneficiary of the $1 trillion in infrastructure plan. So, whilst they may be lagging the majors, the outlook is more appealing from here. Flutter is an Irish bookmaking holding company created by the merger of Paddy Power and Betfair. Now, since the initial merger, the group now operates under various brands including Paddy Power, PokerStars, Skybet, Sportsbet.com.au, Timeform, TVG Network, Adjarabet, BetEasy, Betfair, FanDuel, Foxbet and Full Tilt Poker. Flutter came about when Paddy Power and British rival Betfair agreed terms for a merger on the 8th of September 2015. The business is owned 52% by the former Paddy Power shareholders and 48% by the former Betfair shareholders. The merger was completed in February 2016. From here, the group then went on to make several acquisitions. In May 2018, Paddy Power Betfair announced its intentions to acquire FanDuel, one of the leading daily fantasy sports operators in the US. Now, the deal was part of an effort to increase the company's exposure in the US following the overturning of a federal prohibition on sports betting. Now, as part of the acquisition, the company merged its existing US operations into FanDuel to form FanDuel Group. February 2019 saw the company announce the acquisition of a 51% controlling stake in Adjarabet, a business operating in the Georgian gambling industry. March 2019, Paddy Power Betfair then announced that it would rebrand as Flutter Entertainment. Flutter was originally the name of a betting exchange acquired by Betfair in December 2001. October 2019, Flutter Entertainment announced its acquisition of Canadian gaming operator The Stars Group for $6.95 billion, creating the world's largest online gambling company based on revenues. The new business maintains separate brands in the UK, Ireland and Italy. It operates across 4 main divisions: online, retail, Australia and the United States. The online division comprises Paddy Power and Betfair in the UK and Ireland, and Betfair also operates an online betting exchange. The retail division operates over 600 betting shops in the UK and Ireland. In Australia, they own Sportsbet. The division in the US includes FanDuel, FoxBet, a partnership with Fox Corporation and its Fox Sports Media Group, and the TVG network, which is a horse racing television channel, and Pari-Mutuel online betting network, which is active in 35 states. In New Jersey, the company has an online casino and a horse racing betting exchange. So, recent figures turned out to be very impressive as we see the return of normal sports events. The return of a more normalised sporting calendar was a major contributor towards the reported first half revenues of £3.1 billion. That was up 30% year on year. Customer volumes were similarly higher, with average monthly players up 40% over the 6 months compared to last year. Quote, "The first half of 2021 exceeded our expectations," said Chief Exec Peter Jackson. "Our global sports businesses benefited from further enhancements to our products and the return to more normalised sporting calendars, while we sustained our strong performance in gaming despite the challenging comparative set last year." But it's not just the figures that appeal. It's a sector in huge consolidation, with MGM circling the sector. Now, granted, a bid approach for Flutter could be tricky with a market cap of $32.8 billion. But that being said, the fact they owned 95% of FanDuel is the largest online sportsbook operator in the US, with Flutter recently saying it has a 45% share in the world's fastest growing sports wagering market, it would certainly make it an appealing proposition. Reckitt Benckiser Group plc engages in the manufacture and trade of health, hygiene and home products. It operates through health and hygiene home segments. Now, the health segment focuses on infant and child nutrition, health relief, health hygiene and vitamins, minerals and supplements. Now, the hygiene home segment focuses on the household sector. The company was founded in December 1999 and is headquartered in Slough over here in the UK. As far as brands go, well, many of its brands are well-known household names, as you can see here. Now, Reckitt's share price has been squeezed hard in recent trading, especially after recent figures highlighted concerns surrounding their bottom line. Adjusted operating profit in the first half fell 16%. That's a 9.6% fall at constant currencies, down to £1.4 billion, whilst on a statutory basis it made a first half loss of £1.9 billion, driven by a near £3 billion charge from its agreement to sell its infant nutrition business in China, and a £165 million loss on the sale of its Scholl business. The major contributing factor to the negative figures was the inflationary pressures, and despite the assumption that big consumer goods companies with such strong brands can easily pass on any extra cost to the customer in the form of higher prices, this in reality hasn't transpired as of yet. So, whilst recent news flows haven't been entirely positive, this is also reflected in the current price. So the company's infant nutrition business has continued to worry analysts, seen by most as a big mistake, but one they are at least trying to rectify. So Reckitt added a lot of debt to its balance sheet to buy Mead Johnson 4 years ago, and the business has been a constant source of problems ever since. Whilst the issues are very much prominent at the moment, a lot of the problems can be overcome, and whilst inflation has squeezed, they can take steps to offset. The infant formula acquisition was a costly mistake, but at least Reckitt is taking steps to fix that. Meanwhile, the Reckitt share price fall means that the current dividend yield is 3.1%. MEDICLINIC International was founded in 1983 in Stellenbosch and is an international private hospital group with operations in South Africa, Namibia, Switzerland and the United Arab Emirates. The group's head office is based in Stellenbosch in South Africa. Now, they acquired Hazelden, the largest private hospital group in Switzerland, for 2.54 billion Swiss francs in 2007. In June 2015, they acquired a 29.9% interest in Spire Healthcare, that was a UK-based private healthcare group, and then announced a reverse merger of Al Noor Hospitals in October 2015. Now, the former MEDICLINIC shareholders owned up to 93% of the combined business on completion, and the merger was completed on the 15th of Feb 2016. So the healthcare group officially started trading on the LSE on the 16th of February 2016. So they operate in 3 key regions: Switzerland, Southern Africa and the Middle East. And operations comprise of 74 hospitals, 5 subacute hospitals, 2 mental health facilities, 18 day case clinics and 20 outpatient clinics. Hazelden in Switzerland operates 17 hospitals, 4 day case clinics in Switzerland with more than 1,900 inpatient beds. Southern Africa operations include 50 hospitals, 3 of which are in Namibia, 5 subacute hospitals, 2 mental health facilities and 12 day case clinics across South Africa, and of course around 8,600 inpatient beds. The Middle East operates 7 hospitals, 2 day case clinics and 20 outpatient clinics with more than 950 inpatient beds in the UAE. In addition, under a management contract, the Middle East operates 1 hospital in Abu Dhabi and will open a 200-bed hospital in the Kingdom of Saudi Arabia in mid-2022. So, with the ongoing pandemic, varied pace of vaccine rollouts and planning assumptions of further waves and variants are causing continued uncertainty on the recovery for the MEDICLINIC share price, and this is holding them back and offering a great entry for the longer term. However, in line with the outlook statement provided as part of the 2021 financial year results, and given the group's focus on operational and cost efficiencies, it did not anticipate any long-term structural impediments in returning EBITDA margins. Now, whilst the short term may well still offer a degree of uncertainty, this is also what offers the attractive entry level. Goldman Sachs have also added to this conviction, highlighting they are, quote, the cheapest stock in its healthcare coverage, and that the underperformance provides an attractive entry point, and highlights the improvements in free cash flow will help to drive the reinstatement of dividends. So there you have it, our top 5 picks that we believe are the best St Leger's Day bargains this year. And of course, you are welcome to check back again this time next year to see how we did. Until then, of course, we here at Atlantic Capital Markets, as always, will keep an eye on things and keep you regularly updated with all the key events happening around the world's markets as they happen. Until next time.